Google stock is down 7% in the past year. However, Barron's published an article a couple of months ago suggesting it could rally up 50%. In order to find this out, I'm going to do an in-depth analysis of the company by looking at the financials, the forecast, some important statistics. I'm going to use my Google Sheet to calculate the intrinsic value of the company. We're also going to look at some risks in investing in this stock, and I'm also going to reveal if I'm going to add it to my portfolio. Starting with the financials, Google's revenue has grown very nicely and very consistently over the past 5 years, going from $182 billion all the way to $359 billion, which is an average of around 11%, so very consistent revenue growth. Moreover, their profit has also grown very nicely, with net income growing from $40 billion all the way to $111 billion in the past 12 months. And their free cash flow is a bit lower, which is something that I don't really like, but it has gone from $42 billion to $72 billion, although I expect free cash flow to catch up with net income. Their margins are also very nice, with gross margin being at around 60%, and profit margin has also increased in the past years, and it is currently at 30%. To calculate the intrinsic value of the company, I use my discounted cash flow and net income model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. As a long-term value investor, I did a 7-year analysis with a low case, middle, and high case. As you can see, according to my low case, the intrinsic value is $138 per share. According to my middle case, $195 per share, and according to my high case, $270 per share. This also means that according to my low case, you're going to make a 5.6% annual return on your money, middle 11.8%, and high 17.7%. Therefore, if you believe my middle or high assumptions, you're going to get some decent returns, nothing out of this world, but some beating the market results, which is very decent for such a large company. And by the way, these returns include the dividend. Moreover, if we take a look at the historical PE ratio for this company, it is trading at an all-time low in terms of the past 5 years, and it is currently trading at a 19 PE, which is something that only happened in 2022. However, if we take a look at the historical free cash flow, it is trading quite expensive at 29 price to free cash flow. However, as I said before, I expect the price to free cash flow to match the PE in the future, because I expect free cash flow to catch up with net income. If you want access to the spreadsheet, I'm going to leave a link in the description. The main reason why people don't want to invest in Google is because of the AI race. However, if we take a look at the LLM leaderboard, we're going to see that the best overall ranked search is Gemini 2.5 Pro. Moreover, if we take a look at Google revenue by segment, we're going to see that Google search in the last quarter grew by 10%, the previous 12%, and the previous one 12%. This does not mean that Google is going to come up on top of the AI race. However, what I believe is that all companies are going to benefit from AI. Finally, to answer the question on whether I am going to add Google to the YouTube stock portfolio, the answer to that question is no. Because although I believe Google is fairly valued, and I think you could get a decent return investing in Google at today's price, which is $176 per share, I prefer to invest in stocks that I believe are heavily discounted. For example, Alibaba, which we are currently up 41%, PayPal, which we are up 38%, Walgreens, which we are down almost 40%, and SoFi, in which we are up 165%. In conclusion, I believe Google is fairly priced right now, but I am personally waiting for the stock to get cheaper. I hope you found this video valuable. Let me know what you think about Google stock in the comments, and I'll see you in the next one.